How I start my day, top-down analysis. After you do your top-down analysis, you should always check the news. So the market structure is that we've been in a funnel. I would probably enter here because we're at the area of interest, we're at the trend line. I would be setting my stop somewhere around here. Ideally, you want to be at a 1-to-3 ratio in all of your trades. If you're trading consistently at a 1-to-3, then all you have to win is 40% of your trades to be profitable. You can kind of do this with your eyes closed.
Good morning, TradeLocker.
Okay, so this is AUD USD. This is my favorite currency pair. And you can see all my favorites here. I like USD evidently. AUD USD and also Bitcoin. Probably my two favorites. GBP, JPY, I like when I'm feeling a little adventurous. Occasionally they have good setups, but I'm gonna show you how I start my day, how you're supposed to start your day, is what they call top-down analysis. And that means that you start from the highest time frame that you read and you go down. So I'm currently on the daily and I'll be looking for any major market structure. So my rule of thumb is that the two biggest things I use in trading is market structure and price action. And price action kind of trumps market structure because price action is what validates or invalidates market structure. So for example, here, let's say these 2 wicks right here, for example. I'm gonna draw a line there. You see these two lines? That's a huge area of interest on the daily, right? Because every time the price touched these, it created a wick, which shows volatility, and it quickly reversed up. The first one rolled all the way up to here. The second one has written all the way up to here. And if you see how many times we hit this same area, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So this is also an area. So I would also be putting a line here just so I have a visual representation of that on the chart. And I'll put it on average between all these wicks. So now I know that those two areas are really, really important on a daily. This is what they call a supply and demand zone. And what makes it a supply and demand zone is that the price reacts like violently off of it. Like wicks usually show volatility. And that basically means that there's, matter of fact, look over here, there's another one where it bounced off that area. So anyway, anytime you see wicks like that and the price bounces up to an extreme measure after hitting a zone like that, you want to go ahead and mark it. And if you were in a trade and it start nearing that area, you either want to close it or put your trailing stop on or something, because you know it could be a violent reaction there. So I mark those on the daily. I can go in and see, say, for example, that this is a trend. I could mark that if I wanted to as part of my analysis. If you see that right there, that's technically, bring that in a little bit, because the trend started flattening out after this volatility set down. So you have a trend there. And now I'm going to go to the 4-hour and just clean it up. So that trend, change the color of that, it stands out. And then from the 4-hour, so if you're working or if you're not a person that can be committed to the chart, if you don't have like 2 hours set aside each day to just really sit in the charts and place quality trades, a higher time frame will probably be better for you. So it will be a good place where you can enter a trade with a smaller size and just kind of forget about it. You set your alarms and your alarms let you know when you want to get back in and when you want to revisit your trade, or you can just set your take profit like so. Over here you have your take profit and stop losses like that. So insofar, this is something I wouldn't trade because it's so close to the area of interest. The trend shows that we should continue, but because we're in the area of interest, it's likely to reverse. So real world scenario, what I would do right here is set an alarm underneath this and set an alarm above it. That way it breaks through this area of interest, I would know to jump in and place a buy order. And if it fails and rejects off of this area of interest, I would know to come in with a sell order here. So this is kind of what I call just setting up a trade, and just like they say in trading, we get paid to wait. You're better off just waiting for a quality trade than to take a trade that you're unsure of. And all the money you save is money that you made. So that's something like I will come here. And my bet is that it's going to reverse. So I'm just going to, where's the feature here? I'm looking for, is there an alarm button in TradingView like there is TradeLocker?
Price alerts are not yet available.
Okay.
But not yet.
Okay, no worries. Yeah, I normally set alerts in, like I have automated alerts in TradeLocker. For example, if the price moves 1% within, I want to say it's like 2 bars, I'll get a push notification to my phone.
Yeah.
Because that usually lets me know we touched the area of interest or a supplier demand zone, and those are usually good places to do fadeaways.
Yeah, that
So
can be
that's how I
really
was.
bring as well, but it takes some time to develop.
Oh yeah. I've seen even since, let's see, this makes maybe month 4 that I've been back, and I've seen all the improvements for sure. I'm really excited about it. That y'all been rolling stuff out. Seems like on a weekly basis y'all roll out something new. So
That's the
no
goal.
worries.
One or two, mainly two releases per week. It doesn't matter if it's a bigger feature or the bug fixes, but one or two releases per week. That's the goal.
Okay, cool. That's what it seems like. I've been eating it up. Always looking forward to see what you put out each week. So I'm gonna go to another chart. I'm gonna switch over to Bitcoin and see what's going on there. I also want to mind you that after you do your top-down analysis, you should always check the news. That's why I have this tab pulled. This is E8, which I'm in the U.S. and they're not allowed to sell to U.S. clients anymore. But I love their calendar because it just looks cool, and then it's very easy to use. So like, let's say I'm trading AUD USD. I just click on both of those and I click the day of the week, and it'll automatically filter out and show me the news for the day, and it'll show it in my time zone, which I appreciate.
There
So
was some
7:30.
there was some pretty big news today about the inflation rate and so on.
So those you usually want to check once you figure out which pair you want to trade. Like, you don't have to do this first thing, but once you kind of skim through all your pairs and you find which one did, or which 2 or 3, I prefer to do one thing at a time. But if you see a good setup, the very next thing you'll want to do is check the news. You do not want to trade during news. Some people, that's their strategy, but it's not mine for sure. Like I said, I used to trade news, and then I had a stop loss that was blown through completely, and I didn't count. Like, because the news can be so volatile that it can blow through a stop loss. So there's no guarantee. That's why I say, like, if you just must trade the news, just throw a small amount of petty cash in a separate account, something that you can lose, But as far as your main account news trading, I don't recommend. And I try to close out my trades before any news comes out. So 7:30 and 9:30, anything that's low is normally not anything to be worried about. It's the high impact news that you want to be weary of. And since we're in the clear, since the news is at 7:30, we don't have anything to worry about until 8:30 p.m. And that's because that's when Australia's comes out. So if I were to trade AUD, I would be good. So this is Bitcoin. I'm going to go back to a daily chart. Start the day with my top-down analysis. Another thing I always say as part of your morning routine is to identify the market conditions. Because I'm not going to hold y'all. There's some days where I mean, even several days at a time where I won't trade at all. If the market looks like it's really volatile and I can't figure out what the market structure is or the patterns, then I just sit on my hands and I wait until it's something discerning and something that makes more. So 1, top-down analysis. Number 2, market conditions. It's either going to be trending, or it's going to be consolidating, or it's going to be volatile. I'll trade anything but volatility. And then, like I said, I would say the third thing before you enter your trades, after you find your setups, would be to check the news. So this is a daily time frame for Bitcoin. Bitcoin has been beautiful really all summer, because if you can see, let me get my little trend line. It's been bouncing off of these points almost every time it goes. Make this in red because I said I'm gonna make it thick. Every time it hits this trend line, it drops. And it looks like each drop has gotten deeper. I don't know if we're gonna go back and try this and challenge this trend line again, or if we're gonna drop down, but this is, literally like classic example of a funnel. You see these lines. We're trading perfectly within these lines. So your entries here would be nearing these lines, and there's of course micro entries in between. Like, for example, you can see a trend within it here forming. See how these let me change the paper. So for the past 3 days, at least, actually longer than that, we've been in a little trend going up. But if you zoom in, you can see we're meeting resistance right here. So that's kind of what I call indecision in the market. Like it's trying to decide. You see how these points, 1, 2, that's almost a perfect touch and bounce off of these lines. So the market structure is that we've been in a funnel since May. We've been trading within this funnel. And then starting on August 8th, we've been meeting a resistance level and challenging it. So far, we've challenged it at least 5 times. And usually with a pattern like this, it gets smaller and smaller, and then it breaks out in one direction. So this is one of those situations where the market is direction. But we'll zoom in on the 4 hour and see, do we see anything within that trend that's tradable? So if I were going to take a trade right here, I would do, let's see, I would probably enter here because we're at the area of interest, we're at the trend line, and I would be looking to take profit, not right at the resistance level, but just somewhere close to it. If you try to be too perfect in trading, a lot of times you'll miss a lot of opportunities. It doesn't have to be perfect. It doesn't have to touch this line exactly. I would be setting my stop somewhere around here. Ideally, you want to be at a 1-to-3 ratio in all of your trades. If you're trading consistently at a 1-to-3, then all you have to win is 40% of your trades to be profitable. I don't know if any of you have ever looked at a chart that shows you like your winning percentage versus your risk to reward ratio, but even at a 1-to-1, you only have to be right like maybe 60% of the time. You can kind of do this with your eyes closed. If you trade with a small enough lot size to where you don't get stopped out, your price will almost always work in your favor.
So it's a 1-to-3 ratio plus trailing stop loss.
Yes, yeah. I try to aim for a 1-to-3, and if I trade at a 1-to-1 or a 1-to-2 ratio, it's usually, I don't want to say a scalp, but it's just usually an obvious trade, or what I call a straddle. Meaning if we're consolidating in the zone, like for example, this would be a 1-to-1, and since we've been in this area for so long, I could almost put this anytime it gets to the center, to the median of these, I could technically enter a trade and it's gonna go up and down. Does that make sense? Like technically it's probably a 80% or 90% chance that it's gonna go here because it has done it so many times, consolidated. So that's what I would say. Like I would say that since that has such a high probability of winning, that you can lower the ratio down to a 1-to-3. But ideally, yeah, you want to be at about a 1-to-3, 1-to-2. Like I said, all you need is 40% at a 1-to-3. So I would be about right here. If we had entered here when we first saw it, we'd be at a 1.277, and that'd be good enough. Once the trade bounces to this area right here where I'm pointing, you can put a trend stop on, and then it'll either take you out in profit, or if it plows through this and goes to the moon, then you'll be able to get it you'll be able to milk it for as much as you can. But that's what I mean when I say using my trailing stop loss smart. Most of the time when I put on a trailing stop, I prefer to use it once I've actually reached my profit target. So let's say I went in here at a 1-to-2 and the trade went to 1-to-2, and I'm like, okay, I technically would be good with my profits here, but because the price action is still moving in profit, I'm gonna put a trailing stop on to see how much I can get. That way it'll give me all the profits, and if it reverses on me, it'll still take me out in profit. That's what I call milking the trade.
Oh, that makes sense. That's really smart. Milking the profit, okay.
Yeah. So like I said, the only other time is if you're working or you're busy and you can't babysit a trade. One stop is great, but it's also really helpful if you're already in profit. Those have been probably some of my biggest trades, has been using that. That's why I was so excited when it came out. I was like, ooh, yeah, it's like instead of you just taking the 1-to-2, you secure your 1-to-2, but then it could go 1-to-10, and you've already secured your profit. So I love that feature. But yeah, that's the move I would make on that one. I'll look and see if there's. So for my strategy and my trading style, I haven't seen. It seems to me like the market is consolidating a bit, but it's August, which means it's like for y'all who's saying you're gonna quit. Now is not the time to quit. The summers can be slow. Well, they say sell in May and go away. So a lot of the banks and stuff, like stockbrokers, like they sell their assets and they go take vacation for 3 months. And you'll take vacation for 3 months when you get really good at trading. But things get kind of slow and kind of volatile during the summer because there's not as much liquidity. But when August rolls around, that's game time. August, September, October, November are usually some of the prime months for trading. And then after the holidays, January through about April are also prime. That's when you'll see the vast majority of liquidity, your biggest trades. So if you're gonna quit, wait till December to quit.
Just give yourself 1 month of fall, just one.
Really though. So let me see if I can turn these. It's kind of distracting. I like them because it helps remind me when the market is going to close, because I have such a wonky sleep schedule that when everybody's winding down, I'm winding up. So I don't know how y'all feel about it, but if I can help it to not hold over the market close, like at 4 p.m. our time US, I try to close out those trades. But if it's a great trade and it's in profit and it's running good, I'll leave it alone and let it roll into the next session. But that hour where the market closes, not only are you acquiring swap fees, but if you have a tight stop loss, a lot of times, because there's no liquidity, you'll have a lot of candle wicks and stuff, and they can take out your stop loss. So I actually used to have an alarm that would go off every day at 3 p.m. to remind me to close my trades. It was the Bridgerton theme song. And that's funny I say that, my alarm goes off. Yeah, I used to have an alarm reminding me of market open and an alarm reminding me of market close. That way I can go revisit my positions and see which ones I want to close and if I want to leave them running. Last thing you want to do is be stuck in a position with the market close, and there's nothing you can do about it. So this is on the 4-hour GBP USD, and there was a beautiful trend. You can see here with this orange. The trend started on July 22nd. We've been in this beautiful downtrend. We broke this trend on August 9th, and we appear to be in an uptrend. I would say we are, because we've already taken out what they call a lower high. This is the lower high. This is the lower low. We came up and took this out. So this area right here makes it a reversal. And now we'll keep challenging these points of entry. So we're challenging this one now, if that makes sense. While we're here, to get into price action, because I think this is a great example of them. You see we got a doji here, and this is just a 4-hour. 4-hour is pretty reliable indicator, price action. I prefer trading on the Q15, but the 4-hour gives you a good grasp of the overall picture. So anytime I see a long wick like that, where it lets me know that it's bouncing off of something. We already kind of highlighted this as an area of interest because we broke structure here. And looks like we tried to make an effort to go back down and we bounced off. We didn't even get close to it. Pretty much bounced back up and made a wick, which is a good sign that the trend is going to try to continue up, but it would need to get through this level because this is lower high on the previous trend. So
there's a question I want to answer it. Would you consider this week a retest?
This one?
Viera.
I wouldn't consider it a retest. So for me, a retest would actually come down and hit this zone, or it would kind of come down slowly and hit it. This kind of seems like it did try to reverse and it just wasn't able to because the market structure here is too strong. So here, I'm gonna go back to the Bitcoin charts to kind of answer that. That's a good question. So I've read before that, let me get back to the daily time. The further apart your rejections are, the more reliable it is, if that makes sense. So if you're on a Q5-minute time frame, you see, try to find an example. I'll start by using this one as an example. So for example, this Bitcoin chart, its first rejection was in March. So twice in March we rejected off of this, again in April. Then we came back in May and rejected off of it, and then again in June. Then we rejected off again in July. Those points are so far apart that means that this is a more reliable area of interest as far as it being a reversal, if that makes sense. Whereas if they were all close together, let me try to find an example. If they're close together, that basically means there's no respect. So a true reversal or a true demand or supply zone is so powerful that sometimes your price can just get close to it and it'll react violently, like it'll bounce off of it extremely quick, right? Whereas if you keep hitting an area over and over and over again, that means there's no respect there. There's not enough buy orders there does that make sense? Like to reverse it quickly. It's like price action is just playing with this zone, knowing that it can push through. If it's a true reversal or a true area of interest, a true demand zone, you'll know because of how quickly it bounces off. And when the trade is going down, it's essentially accumulating order. It's accumulating, like us retail traders, we see it going down, and so we sell and sell and sell and sell. Well, when they reverse it, that's when they snatch all our money for those of us who are not trading with a stop loss or a trailing stop. When they reverse on us, they're using that liquidity to power their move to the upside. So let's say we were trading down. This is all the retail traders, it's going down. We're going to sell. All these retail traders don't have stop losses set and they're just riding it out, being greedy. They haven't secured their profits. They haven't secured partials. And then let's say this is JP Morgan Bank sitting right here, who's like, you know what? We're going to reverse this and take all of those. We're going to wipe out all of those stop losses. That'll give us the power to kind of push through. It would reverse here and shoot back up, if that makes sense. And it'll try to use that liquidity to kind of push through the zone. We spent all this time accumulating orders. For 2 months, we spent time accumulating orders. We took all of them out and we still can't cross over this area. That means that's a very powerful order block. Very, very powerful. Like, look how we reacted off of this one. We tried again to hit this trend line 3 months later, and we still got knocked out of the park to the downside. That lets you know how powerful it is. So it's kind of a matter of respect. Like, if you see a bunch of orders grouped together, we keep testing an area like this right here. This candle has hit this 1, 2, 3, 4, 5 several times. And although it's showing resistance, if it were truly a demand zone, it would have bounced off of this like really tough and dropped down there. So if the price is willing to even keep going and touching the price over and over again, it's already kind of weak. Each time price touches this resistance area, it gets weaker and weaker and weaker each time because it's hitting it back to back to back. So eventually it's going to touch this area and pop through and go up there. And one of the reasons why is because us retail traders are saying, oh, this is let me give you a little rectangle. If we were going to trade this to the downside, because we're like, oh, there's resistance right here. So I'm going to place my sell order right here. I'm going to keep entering at this. Well, this is our stop loss area. The vast majority of us will put our stop losses in this area. Well, the banks know that. So after they hit this repeatedly, they dangle it in front of our face. They'll just reverse it at some point and wipe out all of these stop losses. That gives them liquidity to push price up here. So you kind of start to develop like what I call a vulture after a while. You know, like everybody's placing their stop losses and you know how to take them out. Here's a perfect example right here. I'm gonna move this down. You see right here how we hit this 1, 2, 3 times. We hit this zone 3 times. So your average day trader would be like, oh, okay, there's resistance right there. So I'm gonna place a buy order here to the upside. And if you had a trailing stop, you'll be fine. But if you didn't, then look what it did shortly after. We went up. We actually even reached it's gotta be at least a 1 to 3. Yeah, that's the wrong, that was that 3. Yeah, that's a 1 to 3 right there. But because it hit this area of resistance so many times, most people entered at this resistance level and used it to place their stop losses because, you know, natural resistance levels are kind of there for, you know, what you perceive to be your protection. And it goes up, you get a 1 to 3, and then it reverses and plows right through there where it just took out all of these stop losses. If that doesn't make sense, let me know. That's kind of volatile. It's a good idea to just stick to your strategy. If you're 1 to 2 or 1 to 3, get your money and get out because anytime you have a resistance level, it's quickly liquidated by retail traders seeing that level and placing their stop losses there. But then the banks will target those levels because the stop losses are all there. That's a vast majority of what liquidity is taking out retail stop loss. Sorry. Miss J, explain the part about the stop losses and let me see if I can find a better example. This chart is sideways. Let me see if I can. So I'm looking for symmetry, y'all. That's what I'm kind of scanning. Go to AUDU, favorite pair. I just changed time frames from the 4-hour down to see if I can find a better. Okay, this might work. Okay, so if y'all see the symmetry here, I have a trend line drawn from here to here.
Yeah, I see it.
Okay, so retail traders or anybody, right? When you see a trend line forming, of course you want to get in at some point during the trend line. A trend line is anytime you have 2 or more points along the same line. So here's point 1, here's point 2. Once you hit point 2 and you bounce off of it, most of us are going to enter at point 3. We have clearly established a trend line. So let's say you come in with this little tool might be throwing people off too. So let's say you come in right here at this 3rd point and you set your stop loss, the most recent reverse, which is here. You want to set it a little bit lower.
Yeah.
And let's say your goal is a 1 to 3. So put about right there. You enter your trade here and you let it run, right? You could technically, and I've done this before, sometimes I'll stack positions. So I'll enter several times along the trend line. If it's a pretty trend line, this one is not. But if it were pretty, I would stack my positions. And once I go far enough in profit with one, I'll build another position. This one is not that great, but so let's say you enter here, but let's say there were retail traders that entered here and they entered here and then they entered here. Each time you enter, you're placing your stop loss like at the previous area entrance. Previous, in this case, it would be your lower high. This is a lower high. This is a higher low, higher low, higher low. So if you entered here, your stop loss is there. You entered here, your stop loss is here. You entered here, your stop loss is here. So from here all the way down to here, there's stop losses for retail traders. Well, everybody knows that, including the banks. So at some point, it would make sense that they reverse the trade and go back down here and wipe all of these stop losses out before continuing on. That will boot you out of your trade. They would take your profits, and then it would continue up as it was going in the first place. That's why securing your profits is so important. Even if you're right, there's still what we call liquidity grabs, where every now and then the market will reverse just to take out your stop loss. That's how it works. It kind of gets, that's how it gets fueled. So you kind of want to, like I said, that's why a lot of people say, like, even if the trade is still moving up, they'll go ahead and take out profits at their trade. If their trading plan was 1 to 2, they go ahead and secure their profits at 1 to 2, because the likelihood of reversing at 1 to 5 or 1 to 6 is a lot bigger. A lot of times when you get those 1 to 10 risk reward ratios, those are reversals. And reversals are like, you can find them. I'm not going to say they're rare, but it takes a high level of skill to be able to spot them. Like, they have a high failure rate. And so you're basically waiting for really, really big supply and demand zones to get into. I want to find it. Here's a better example. This is like hypothetical. Let me get rid of this. So you see I have this line drawn here? That is showing that we have 1, 2, 3 times that we've hit this area. So this is evidently a area, right? So let's say if you zoom in, especially if you're a scalper, you would just be eating this up. Every time we hit this line, we reverse. Every single time we hit this line, we reverse. So it hit it 4 times here and reversed, and it came back up and challenged it again. We got a wick. So right here, most people will be looking to enter because we bounced off of it again, and it's a wick, which shows that it's kind of volatile. So let's say you jump in and you do a short right here. You place your stop loss just a little bit above line so you have some wiggle room, and you're going to play this to the downside, right? You can play that down as far as you want, but it wouldn't surprise me if at some point the market reversed and went all the way through this point just to take out those stop loss. So I'll show you. Let me find that little arrow thingy, and I'll give you an example. There's like there we go. So we went here, I don't like that. We bounced off and went here, tried again, bounced off, went down to here. Now, when we get ready to go back up to here, institutions know that retail traders have their stop losses placed all along here because they've been trading dejections. So it would make sense that at some point they go through this line and take your money, because they're in the business of making money.
Yep, everybody is.
Right. So this is where, greed and securing profits and sticking to your trading plan comes in. Because if you entered here, you could secure your profits anywhere. You could secure them here. When we break this trend, you could secure them. Or you could just secure them at a 1 to 3 because that's your trading plan, is to clock out at a 1 to 3. But if you don't, and you decide to ride it out, and you don't have a trailing stop, and you haven't looked at stop loss, don't be surprised that they come all the way up through here just to take out your stop loss, and then they continue that. That happens a lot, like a whole lot. So some people call it stop loss. I mean, it's just, this is something in here I saw that I would show. See that wick right there?
Some more questions and comments if you want to check them out.
Sure. So you close your trade, or how do you take it out and trade going? So me personally, that's when market structure comes in. Like, if this is a really, really strong resistance line, let me zoom in. Ideally, what you do is, let's say you entered, or what I do, I can't tell anybody how to trade, but let's say you entered here, or about right here, your stop loss is here, and the trade's going in your favor, and you're already at a 1 to 3, and you know your typical setup goes 1 to 3, you can just close out on strategy alone. 1 to 3 is really good in trading. It just, for me, it is. Some people do 1 to 4, 1 to 6, but for me, 1 to 3 is something that you can pretty much do every day. You might only find 1 or 2 setups, but it's doable every day if you want to be consistent. And I used to have a TradeZella account where it analyzed my trades and stuff like that. And I always did my best at 2 or 3 trades a day. Anything more than that, and I was pretty much giving money back to the market. 3 quality trades a day, 2 or 3 quality trades a day will make you. You don't have to trade 10, you don't have to overdo it. But ideally, what I tend to do is, like, if I entered here and then I became in profit here, I actually just move this down. I move my stop loss to in profit. I tighten it like this. That way I know it'll take me out in profit, even if the trade reverses. That kind of helps you be in a risk-free trade. And that's not a bad strategy to have in general. Once your trade goes in profit, drop your stop loss, and then you're in a risk-free trade. So that's how I would trade that. But I would definitely probably be closing it out at a 1 to 3. But overall, if you hear nothing else, your price action will tell you. Your price action will show you, like, when to close out that trade. So, like, let's say you entered here and you were following this trend, traded it all the way up to here. Your price action is telling you that you're meeting resistance right here. So that's where you close. And if you enter here and you trade it all the way back down to here, I would be looking for, like, wicks or any type of sign of reversal. I would be looking at my candles, like, really, really close. Because your candles, the shape of your candles and the way they form is what's going to tell you. That's actually why my chart, you notice that, like, I don't have the green and red candles. I have pink and purple, and they look very similar. I do that so I don't get distracted by whether it's a bearish or a bullish candle. Because I think what's more important than anything is the shape of the candle and the behavior in the way that it looks next to other candles. More important than the color of it. So I do that on purpose so that I don't be like, oh my God, it's red, I have to hurry up and sell. Like, no, like what is the actual behavior of the candle doing in that moment? See if I can. JBP is very spicy, so let's. They got interesting behavior. Oh no, it's loaded. Yeah, these candles are usually like, okay, so this technically is the uptrend. Trying to see where would be your end of the wick. So let's say I got in right here, for example. You can see that from a mile away. There's a wick right there. Let's just say I was feeling adventurous and I decided to play off of this wick. And I do that sometimes for real. If I see a wick, sometimes I'll just kind of fade it. Because that usually means it's touched the area of interest bouncing. But let's say I enter it right here because wick and I was playing this to the upside and it was going up and it's going up, This is my exit because my price action is showing me like this candle is rejecting off of this. We hit this area this time, we dropped, we challenged it again, failed, we came and challenged it again, barely got higher, we challenged it again and we still, that's my exit. Like it challenged it 3 times. So my exit is gonna be where I'm seeing resistance. Because at that point the market is getting ready to make a move. And I can't say for certain what that move is going to be. So I'm going to secure my profit. This is a 1 or 2, and I'm going home. I'm saying if I were to ride it all the way up to this area, that's a 1.35. I'm sorry, 3.5. So that's more than a 1. That's more than enough. 3 challenges to this area, and that's a rule that I keep in my little rule book. Anytime you get near an area of interest, go ahead and close out the trade. And then just sit back and wait and see what it's going to do and how it's going to react to that area. The rule of thumb is, and this is important, like when it comes to demand zones, and some of this stuff I'm sorry, like I be assuming people know this stuff already, so sometimes I don't. But like let's say this is a supply zone. When it touches this area and you see it like fail to go through it or to get beyond it, you'll be placing a sell order. So your short would be here and it would be to the downside, right? So what is that? That's the 1 to 3 right there. If you go through a supply or any type of huge order block like that, anytime you plow through it, that's when you play to the upside. Because that means that there's enough power behind it and enough, like I call it institutional involvement, that they have enough power to push it beyond this area, and that usually means you're going to. So those order blocks are really, really significant. And you'll know how the price, based on how the price reacts to them. Either it's going to bounce off of it in reverse, or it's going to plow through it and shoot up. Very seldom will it go into a demand zone like this and consolidate. So your price action, if you ever get stuck in a trade, you're not sure if you can hold it or if you need to sell it, just look at your price action. It should always tell you. And when in doubt, if you're in profit, close. My mentor used to say, never let a good trade go bad, ever.
When in doubt, close your profit. That makes total sense. And it's people really asking a lot, when should I do it? How should I do it? And if you're feeling overwhelmed with ideas and questions, just close it and take your profit.
Absolutely.
You're going to make more soon. Don't worry about it.
Right. And that's a huge point too. That's a good point that you just made. Anytime you have a lack mentality, just go ahead and clock out. Like if you come into the market anxious and worrying if there's going to be more trades or if there's going to be enough trades or good setups, clock out, because you're more than likely going to crash out. Like your mentality has to be when you clock in that there will always be more trades. There will always be quality setups. There are abundant. So if you're not seeing one right now, then wait, and the market will give you quality setup. You don't know when. It might not. You don't know if it'll be in 5 minutes or if it'll be in 5 hours, but trades will always present themselves. So if you're taking a low quality trade that doesn't look good and you're not sure about it, you're just hopeful. I always say, like, you should never, ever, ever have hope when it comes to reading the charts. You should have strategy. If you're like, I'm going to enter this trade and I really hope it works out, you need to go ahead and clock out. Like, you should always enter based on your strategy. And if you're not sure, then just wait. And you'll be so glad you did. 2 hours later, the perfect setup will come. You'll get your 1 to 3 and you can clock out for the day. All you need is 1 trade a day, literally. Yep. And you can be profitable with 1 trade a day, only winning 40% of the time, and you can still be profitable. The part that gets us is fear and greed and anxiety. And anytime you feel any of those things, it'll reflect in your trading. So it's better to just not trade at all and just wait for a setup you're confident in. If you are only good at trading trends, which is the easiest pattern you could ever trade, then trade trends. Even if they only come up once a month, you'll still be profitable because you're trading something that you know. Versus, you might have another trader who has a really complex trading strategy But if that strategy don't work for you, it don't work for you. Just leave that for them to do and for them to master. Only trade what you're comfortable this season. Take profits by ratio, get rid of your own greed, make money, respect you. I do use take profits. I don't use them as much as I probably should. I use them when I know like for example, this is the case where I would use a take profit. Because this little zone here is almost looking kind of like consolidate. So let's say I noticed that price keeps trading in this zone, in the area. I might say I might enter here and set a take profit right there because I know we've gone back and forth here several times. Or, I'll set it close to an area of interest so that I'm not stuck in a trade when the trade like reverses or bounces or anything like that. I do use them, but sparingly. But they're great though. I should use them more. I just prefer trail and stop over take profit because, like I said, I like to milk those trades. If you enter a trade in one direction and profit, for example, are you open? I am, but I'm gonna be honest with you. I do that sometimes, but just on analytics alone, I don't usually do well with those. If that makes sense. In some strange way, psychologically, you'll be fixated. You're not focused on the right thing. And if you enter a trade that quickly, a lot of times you're flirting with greed and fear. If you close a trade at profit and you enter another one right immediately afterwards, a lot of times you're kind of leaning into greed and you're kind of leaning into dopamine. You know what I'm saying? Once you, anytime you make a profit, you get a dopamine hit in your brain. That's very addictive. So you have to be careful that if you close a trade and profit, that you don't jump right back in the market chasing that high. That's the only reason why I would say, be careful with that. It's not that it doesn't work and it's not that it's not profitable, but let's say you catch that fade and it's going well, it's a good chance that because you're on that dopamine high from closing that last trade, you're going to squeeze that next trade too far. More than likely. I can speak for myself now. You might be different. You might not chase dopamine. You might have enough already. Maybe you're on Ritalin. I don't know. But for me, I have to be careful about entering trades back to back too. You can really kind of go into a funnel of greed real. So I do it sometimes, but I have to be very careful with most of it is emotional FOMO we went through. Sure. That was a good question. But yeah, I do that a lot. Not a lot, but I do it sometimes. If it's an area that I've been watching for a long time, like Bitcoin is probably a good example on a larger time frame. I've definitely made the mistake before of trading multiple time frames and getting mixed up. Like I'll know an entry on the daily time frame, but I'll be traded on the 15 and I'll look over something. Sometimes you can just honestly, like the simpler I keep things, the more money I make. So just trading one pair on one time frame usually makes me the most amount of money. So here, like, let's say I suspect that this is going to go back up and hit this zone, and I enter here, I enter there, and I run it all the way up to about right there. Then, yeah, I could also enter there and wait for it to come down. But I would say just to be safe, I wouldn't even wait for it to go all the way up and hit the zone. I would close it, and then I would set an alarm for here and kind of walk away. Like I say, after a good win, a lot of times I'll either take a break, or even if it's just 5 minutes, a lot of times I'll just take 5 minutes. When you have by history change, I'm always changing my lot size. Rephrase that question for me, please. But yeah, it depends. Like this sounds crazy, but I don't like to keep a lot of money in the account sometimes. So if I have a very small for me amount of money in the account, then sometimes I'll trade on a large time frame, like the 4 hour, and I'll trade without a stop loss. Because for one, everything that I have in an account, I'm willing. And for two, believe it or not, most trades revisit the same prices over and over and over again. So if you have time to wait, most of the time a trade will fall back in your favor. You can't do that though if you trade really, really large lot sizes. Like if you're pushing your margin and you're pushing this and stretching your account to its limits, then you don't have any wiggle room for mistakes at all. But if you trade just a really small percentage of your account, like if you're trading like 1% of your account or something, then you have wiggle room. Like even if you're wrong, like the trade will eventually come back. So let's say, for example, make sure I'm doing this right because it's really random. Let's say I entered here with a really small lot size, assuming that it go down. Let's say I thought this trend was going to be down, and it didn't. So this was my entry. I was anticipating on it to continue this trend down, and instead it reversed on me here and went all the way up. As crazy as it sounds, with a small enough lots, your account will tolerate it going all the way up here and coming back down. And then here's your exit because it came back to that same price. Maybe a couple of days later, swap fees later, but it came back to the same price and it even went in profit. So if you trade small enough, you have way more wiggle room. But if you're like more of a scalper or an intraday trader, you have to be far more precise and have higher probability. But yeah, I do measure. So you don't ever see me do it here. But when I first started, I had the app on your phone, the lot size calculator, and I was constantly calculating lot size, risk, comparing the pairs, going with different risk to reward ratios, and it's almost to a point now where I just know, I kind of know the math in my head. So if you're new and you're starting out, you definitely need one of those apps, and you definitely need calculating like all the time. You want to know what you're risking and is it worth it.
Or you can do it directly on TradeLocker.
Oh, you can. Oh, put me on game. Where is it?
Just open up the order, make it bigger, expand the order panel. See the arrow? Yeah.
Yes.
Click on that. Here it is. You can you can calculate based on your risk. You can do anything.
Okay, nice, very nice, beautiful.
And click that click that risk check mark. So based on your input, it will automatically calculate your lots.
Okay, I like that. That's very convenient. Okay, nice. You see, I'm doing this math in my head, and I didn't have to.
Last question is from Emil. Is it good to always take partial profit or depend on market condition?
I personally don't. I think taking partial profits is a great idea, especially if you're building a position. Like if you're building a position in a trending market, it can be good. For me personally, I prefer to just drop my stop loss to profit. That way I can kind of milk the trade for. So it's going to take me out in partial profit either way. That's my way of securing my partial profits. Just move your stop loss down.
Doc in profit is in this PIP calculator, you're measuring 5 to 10% of your entire equity?
Yes, yeah.
Okay.
I believe so. I believe that's how it works.
Do you have your rules written down or you just decide during the trade? Well, rules are not there to be decided at that point, I believe, because you have them written down in your head or written down them somewhere, but you understand that you need to stick to them before you make the trade. And then when you make the trade, you don't make up rules right then and there, right?
Right. So I do have like rubrics, should I say, where sometimes I'll go and revise my strategy, but it's not usually a reference point. The only time that I'll refer to something on paper when I'm trading is to get the percentage probability of a particular pattern. Like, so let's say there's a bear flag forming and I want to decide if I want to make that trade or not. You can look up and see what the probability of a bear flag going in your favor is. It's probably going to be around 60-70%. If it's a pattern that has anything above 60%, since I only need 40% to be profitable, more than likely I'll trade that pattern. But I do have like just for motivational purpose. See, my job has colored printers, so I'm always printing out stuff on their ink. But it's pretty much just a reminder of how fast you can scale your account. And I'll try to post this chart somewhere. It's pretty insightful. Risking 10%, it basically just says risking 10% at a 1-to-3 ratio, even if you only 40% of the time, you can grow your account 100% for every 10 trades you take. So you could grow about 100% a week if you had the time to trade. And then there's just a chart on here that shows the probability of trading. And I can take a picture of that and post it in a group talking about it. But yeah. But you can write down your trading strategy. That way you can like I said, as part of your morning routine, you can look over it and look over your rules and whatever your weakness is. Like for me, fear might be my big thing or lack. So I might have a motivational quote on there that says to be fearless or something. And that's just like your pre-market warm up. That's it. Thank y'all so much. I'm looking forward to jumping back in.
Bazi, thank you so much. Check out our YouTube channel. Find Bazi's first Auditorium. A lot more stuff about psychology in there. Once again, thank you, Bazi. It was great to see you. Guys, enjoy your trading week.